Hello, welcome back to part two of our discussion of itemized deductions. Remember, the total has to be higher. So you don't know for sure if you've got enough itemized deduction until you've gone through all of these pieces. So the next one we're going to talk about is gifts to charity, charitable contributions, if you will. They can be claimed, but here's the situation. You have different limits on what you can deduct depending on who you give it to and your AGI. So this is another situation where AGI is important because the limit on your deduction to charity is not based on how much you give. It's based on how much your income is. Now, to be deductible, it has to be a donation in cash or other property of value. Your time is not deductible. You can't figure out how much the value of your time is. You can deduct mileage, meaning a cents per mile for driving to charitable purposes, maybe collecting coats on a coat drive or something like that. That can be part of your charitable contribution, the cost of opening your car, but your hours spent in the car doing that, no. Okay. Also, your deduction is only available if you give money to a charity or organization. Giving money to an individual, I don't care if it's on GoFundMe or they need it really badly, that is still not, by definition, a deduction for a gift to charitable contribution. So for 2022, okay, the first limit that we run into is for if you're giving cash directly to the charitable organization, your limit is 60% of your AGI. Now that's still pretty high. That's a lot of your income, okay? And so typically is not going to be much of a restriction, but it is there, and you must know about that, okay? So that is the overall limit for cash contributions. Now, what if you give something other than cash, okay? Then there are some different limits. One of them, first of all, is 30% of AGI applies to contributions of appreciated capital gain property. So capital gain property is not business property, not inventory. This is most of your things you own that you don't use in your business. This could be an piece of art. It could be stocks or bonds, any of those things, and it's gone up in value. Okay, if it's gone down in value, don't give it to charity. You should sell it, take the loss, and then give the money to charity. But you don't want to give a depreciated asset. But if it's gone up in value, then you can deduct the amount of the fair value up to 30% of your AGI, okay? So you can actually, if the stock price has gone up since you bought it, then you can get a deduction for the whole price of it, not just what you paid for it, okay? And that's if you give the money to property to a qualified charity. There's a different limit if you give it to a private foundation, which is typically, and you've heard of foundations. Bill Gates has a foundation. Other wealthy people have foundations. They're called private. They're set up as private foundations where they give most of the money, but they will accept donations from others. When you give money to your private foundation, it's only a 20%. If you give stock or something, it's only 20% of AGI limitation, so it's lower. Okay, that 60% of AGI limitation applies to non-cash donation of non-capital gain property. But if it's non-capital gain property, you can't take the value of it. for instance, inventory. So if you're a sole proprietor and you have inventory in your business and you donate it to charity, okay, then you can donate that. You can count that as a donation for the cost of it, not the value, not what you could sell it for, but what it cost you. But then you can go up to 60% of your AGI in that situation. So there's a further investigation you have to do if you give capital gain property, you've donated, okay, and a deductible donation is the fair market value, and it's not stock, okay? If it's tangible personal property, so art, statues, collectibles of some sort, okay? If it is going to be put to an unrelated use, meaning they're going to sell it and use the cash, or they're going to trade it or something like that, then you can't take the full value deduction. You have to take out whatever capital gain you would have been realized if you had sold it. So basically the cost. So it kind of comes back to bite you if they don't use it. So you want to donate tangible personal property, art or something like that, to an art museum. So if it's going to go and be displayed at the art museum, then you get a deduction for the full fair market value of the property up to the 30% limit, of course, but you don't have this problem with having to go back to cost. That only comes into play if it's tangible, doesn't include stocks or bonds and things like that, personal property, okay, that they are going to sell or use in some other way other than what their purpose is, okay? If it's only been held for 1 year, you got a problem for donation, okay? Then it is only what you paid for it. This is called short-term property. It doesn't qualify as capital gain property, okay? No full value of the property. It has to be held more than 1 year, okay? And there are other limitations depending on who's receiving it. So you don't want to really consider short-term property in your possibility of making a deductible contribution to an organization, okay? Now, what do you have to do, as this is one of the things that comes into play, is what do you have to do to prove that you get this deduction, okay? IRS has found over the years that people are willing to fudge these things, especially when it comes to things like donating clothes to Goodwill or whatever, okay? If it's less than $250,000, then some type of canceled check or receipt will be sufficient, okay? So if you just one time you give some money to place or whatever, that's probably going to be fine to have your, be able to show it on your credit card or on your bank statement, or you get a receipt. If it's more than that for the year, you're going to need written acknowledgement. They're going to have to send you something that says we received it and we didn't give you anything in return. Because what was happening is people would buy things from a charity for thousands of dollars, but what they actually did is they got stuff. So they would show, I sent $5,000 to this organization. What was not clear is that they actually got other things in return. This was especially egregious into colleges, which count as a charitable contribution if to give money to a school, but you gave $5,000 and in return you got 50-yard line tickets for the football game. That's not a charitable contribution. You're paying for something, maybe paying too much, okay? And maybe you have to figure out what the difference is between what you paid for it and what you would have in charge if there wasn't a charitable contribution involved. Maybe you paid $5,000 when the value is $3,000, okay? So maybe you overpaid by $2,000, and that part could be a charitable contribution. But not the whole thing. Okay, that's why it has to be a written acknowledgement that says they didn't receive anything in return. That's also why there's a problem with charitable auctions. When you go to an auction and buy something for charity, only the value you overpay is a deduction for a charitable contribution. Okay, and they should not give you this written acknowledgement, right, that says you didn't get anything in return because you did get something. Okay, if you're over limits for AGI, okay, unlike some of the other things that can be carried forward for indefinitely, like investment interest we learned about in the first module, this can only be carried forward for 5 years. So if you go over 60% of your AGI, the amount goes forward to the next year, and then you have to add that to your charitable contributions for that year and see if it's over 60%, right? Okay, and if it is, then it goes forward, but you can only go forward 5 years. Okay. Other issue, first of all, the charitable contribution limits. You first apply the 30%, then overall 60%. So you could have multiple limits that come into play. All right. I think that's that, and there's a separate video that kind of shows that, illustrates the idea that when there's multiple limits that might apply because you gave multiple gifts to multiple charities, and some were in cash and some were, capital gain property, that sort of thing, then you have to apply maybe more than one limit. There's some very specific requirements if you donate your vehicle, because there was a lot of abuse on that. You actually have to show what the charity sold it for. So a couple of years ago, I donated our car to charity, and a couple months later I got a record showing that they had sold it at auction and for how much. So that's the amount that I got to use as a deduction, because that's the fair value, right, of that car, right? Deduction of charity. And I had that documentation. If they challenged what value I put on that car for my deduction, I had that to document it. And so same thing with, and the other thing that we find as a tax preparer, everybody thinks that they give away hundreds and hundreds of dollars of clothes to Goodwill or some other place, and they just show you, they'll give you some little receipt or something like that. And these organizations have quit giving you any value because they got in trouble for trying to give you a value and people using it. So there's no value on them typically. The value of the clothes donated to Goodwill is literally what they can sell it for. It's not what you originally bought it for, not what you originally, it's what they could sell it for now. So it's referred to as kind of the, garage sale value. What would it be worth if you put it out on a garage sale? What could you charge somebody for? And so it's almost always lower than what somebody thinks they should get for their deduction. It's just an issue that needs to come up. Remember, if it's over $500, you've got to list all of the things, items, and the cost, and what you originally paid for it, and how much the value, and all that stuff that you don't have to if it's under $500. So you better have some pretty good records if you're going to take a substantial deduction for taking things to Goodwill. Just so you understand as a tax preparer. All right, a little bit about casualty. Okay, and it really is no longer theft losses because it's been limited. It used to be that if someone stole something from you, okay, it could be deductible casualty, but it's no longer. It's a casualty only if it's attributed to a federally declared disaster area. So I guess if someone looted and stole your stuff because in a federal declared disaster area because all heck breaks loose, okay, then that might be a situation of casualty and theft losses. But otherwise, it's very narrow. It's only if it's been federally declared by the president. Okay, so if your house isn't in that, it doesn't matter what happens to it, what the loss is, okay, you don't have a deductible loss. It has to be sudden. It cannot be gradual deterioration. Okay, it can't be over time. Okay, that your house is falling apart or your car is falling apart, and you just happen to discover it because there is a disaster. Or you can't just say, oh, well, I'm going to have to fix that car now that I'm in a federally declared disaster area. Okay, has to be a sudden, unexpected, unusual. You have to own the property, and you were talking about uninsured. So you're talking about the loss of on the property when I say insurance recovery. So and by the way, you have to submit it for insurance. You can't not submit to insurance, even if you know that it's not going to be covered by insurance. You must still do so in order to take the casualty loss. So if your loss is $10,000 and the insurance company pays you $7,000, okay, then your loss is only $3,000, right? Okay, so that's the first thing we have to worry about is how much is the insurance going to pay out on our loss, okay? And then figuring out the amount of the loss, okay? So casualty loss is the lesser of these two, the smaller amount. So the fair market value right before the casualty happened, the disaster, whatever it was, and fair market value immediately after. So for instance, if your car is completely washed away in a flood, completely lost, then your loss is fair market value. Let's say it was worth blue book value of $2,000 before the flood, and after the flood it's worth $0 because it's gone. Okay, it's completely lost. Then your loss would be $2,000. All right, or it could be lower than that, depending on if the amount of the adjusted basis. That's what you paid for it, for the property. Okay, so you can't have a loss more than what you paid for the property. So it's either the difference in fair market value. Now it gets a little harder if if the thing is not completely gone. If it's just been damaged, so that you kind of have to estimate fair market value before and after. This building had a fair market value of $100,000 before the loss, and it's only $80,000. That's hard to kind of sometimes do. Okay, but you can't have a loss more than what you paid for it. Many places, and the IRS has basically said that if you don't have, I mean, you didn't go out there and you didn't know the loss was coming, so you didn't estimate the value before. You didn't get an appraisal on it. So let's say that your car has a casualty, okay, and you think the value has dropped substantially because of this problem, because it got, water in the engine or whatever. The cost to repair it could be a very good estimate of the difference in fair market value and could be used for that, and often is used for that because of the fact that you probably didn't get a fair market value before and after. So if you have to spend $3,000 to get that car fixed because of this casualty, not because it's just getting worn out or whatever, but because of this casualty, then you may have a casualty loss of $3,000. Okay, has to be in the declared disaster area. Then every disaster or casualty has to be reduced by $100, and then, so this is really going to be hard to get these deductible, has to be more than 10% of AGI. Reported on Form 4684. So we got lots of restrictions, so that means you're not going to come across very many deductible casualty losses. They're pretty rare. Okay, so it's got to be a pretty big loss. It's got to be in a federally declared disaster area. It's got to be not paid by insurance. It's got to be reduced by $100. Okay, it can't be more than you paid for it. Okay, and it's got to be over 10% of AGI. Only the amount over 10% of AGI is deductible. Just like medical expenses. There are no longer other itemized deductions or other miscellaneous itemized deductions that had a 2% floor. Those went away. They just went away altogether. They weren't that benefit, but people will still ask about things like this is where you could deduct costs that you spend to do things for your employer. If you use your car to run errands for your employer and they don't give you money for it, that you could be deducted. It used to be deducted in the miscellaneous itemized deduction. It went away. There are certain job costs, meaning if you bought tools for your job, or if you did other things like that for your job, that you could deduct it as other itemized deduction. All those went away. Okay, that none of those work. The only other itemized deductions, right at the bottom of the Schedule A, the only ones left, okay, are gambling losses. Okay, and these are very restricted. Okay, they can only be deducted to the extent of the gambling winnings. So you put the winnings on the 1040 Schedule 1, okay, and you put losses itemized deduction, which means they only are deductible if the itemized deductions in total are more than, okay, the standard deduction. And non-winning bingo, non-winning lottery tickets, raffle tickets, all those are part of your gambling losses, okay? But you also have the losses in a typical gambling situation. And you've got to have some record of that, okay? You're not going to be able to say, oh, I think I lost a lot, okay? And if you don't have any reported winnings, you're going to have, you're not going to have any deduction. And then casualty and theft losses not on your personal residence, on your personal property, but on income-producing property like rental houses. Those are other itemized deductions. And that situation.